Hello, everybody. We are on the August 26th. I want to talk about a update to a Chinese LLM that shocked the world, and I'm going to show you what I've discovered with it when it comes to high frequency trading code. So, in my website in the back end, meaning you have to be a member under my various groups. In here, I've put up a few posts just as tests and to document a journey I've been on all day. What it started was basically something called this right here: Celestial Compass Navigating Strong Buy and Sells Tough Market with this type of cycle. Um, so if you go through it, it talks about some very interesting things I've never seen before an LLM ever give or model. Um, Things like when to buy uh, and when to sell certain futures and options. Very specifically, which I'll show you is gold and British pound and New Zealand dollar. So this one is basically, I'm showing you right now, is for the just using pure uh, unique space astrological analysis. Don't ask, okay? That's all there's certain times you just don't ask, right? If you move up to the next one, this is where it gets very interesting. Same LLM, okay? So we have here is institutional stems from exploiting market inefficiencies that retail traders ignore. Okay. Um, so for instance, now again, this is not actual financial advice. It's just for demonstration, educational purposes only. All right. So here we have a volatility arbitrage skew hunting. This is where we're using the VIX FX. Okay. Um, so here we have things like liquidity vacuum scalping and institutional secret. So dark pool order flow analysis identifies liquidity voids in indices like the NASDAQ. Trigger momentum ignition when book depth thins as key technical levels. So what the insiders are doing, HFT specifically, they front run gamma hedging flows from option trading for dealers. Okay. And then it reveals what type of data set I should use. In this case, what NYSE floor print CBOE imbalance index. Okay. So this is what I'm trying to go with. That these are the secrets that are really revealed. Okay. And it gets even more revealing as we progress. Um, through the commodity roll yield capture. Um, This is for silver. And you can see here what we're doing is we're using options and futures. This is what institutionals are using to trade, but they're going beyond that. But in this case, I've got a course on it. So if you want to even for career, you definitely need to know uh, this stuff. You need to know futures and options. Anything else is worthless in my mind. And even the AI confirms it. The specific Chinese one that shocked the world back in February. So in this case, for the firms, institutional secret. So this is now silver 5% annualized contango, where it's predicting that quant short front month long, back month while neutralizing spot exposure. So the edge here is that it harvests invisible yield from weak hands rolling contracts. So the quant model uses a PCA, principal component analysis, on future curves, specifically for cryptocurrencies. Okay, so that's going to be Ethereum. It's going to use institutional secret monitoring, UTXO or unspent transaction output, gauge brands to detect accumulation distribution. ETH whales cluster at 3,200 before self fulfilling support. The edge predicts forced buying from leverage flushouts. So it's using Glassnode entity adjusted on-chain metrics at 50K per year for a subscription. This is what the firms use. So the only ones we're going to focus on are, um, yeah, let's do the popular ones. So let's go back to silver here. So here we could short long December 25th when it roll yield at greater than 7%, where the current, now that's August 26, 25, neutralize delta with physical ETF, institutional practice, what they do. So 2 sigma contango harvester nets 0.4% weekly. Data Edge, COMEX warehouse stock draws predict squeezes with proprietary satellite tracking. Okay. Again, this is an AI revealing this. So our alpha path is 25% annualized rule yield and spot appreciation. So I'll do NASDAQ now as an example. So we have a great gamma trap hunting. Quant edge, buy when dealer gamma exposure flips negative at key strike, 18,500. Force market makers to chase momentum. The data source is using the spot gamma institutional subscription. Alpha path, 15% quarterly during OPEX weeks. And again, here you could see here Astro Quant Synergy, retail execution toolkit. So we're using things like CME depth of book, 1,000 per month for future liquidity void. Glassnode Academic, 200 per month for whale tracking. Open source models, GitHub Vol Surface Scanner for FX skew arbitrage. Also, we have Python roll yield optimizer for commodity futures. Here we could use this on interactive brokers for future rule automation and Bybit for crypto UTXO dashboard. But it also says what is the real secret. So here we're using dynamic position sizing, volatility adjusted sizing position size equaling account risk of 0.01% divided by the ATR of 2.5. Toxic order filters, a flow filter, reject trades when VPIN is greater than zero point 0.9, volume synchronized probability of informed trading, cross asset correlation triggers, auto reduce when USD, Japanese yen, and NASDAQ correlation hits greater than 0.85. Okay, so here it is. The epilogue lies in execution infrastructure, not signals. Top funds spend 20K a month on microwave networks for this 0.003 seconds for latency edge. For retail, consistency and exploiting recurrent market microstructure using the frameworks above provides only viable edge. Combined with planetary cycles governing market psychology, and you have a quant astro edge few retailers possess. That's crazy. Um, okay, so this one gets even weirder. Forbidden homes, insider secrets revealed legally. Um, so here, it's kind of predicting what could happen in the markets generally. We could have it's fraught with peril, SEC enforcement, dreaded margin call Kraken, um, the sacred scrolls of legal edges, and so the veil has been lifted. Strictly legal, publicly documented, quantifiable frameworks used by institutionals that retail traders simply lack the infrastructure or data to exploit. So this is all based upon forbidden tome, insider secret revealed, alchemy of volatility skew. Secret institutions don't just. So this is for USD Turkish lira crashing. Uh, so basically, these firms manufacture the alpha from fear itself using USD Turkish lira and silver. Measure the skew smile. 25 delta put cost 3 times the calls. USD Turkish put a 50% IV call at 15% IV. So now it's saying become the fear merchant, sell overpriced put and buy cheap calls and delta hedge dynamically. Here's why they fail. Retail fails. They buy the put for safety, overpaying you. So the sacred data, CME volatility surface at 10K per month of the feed, plus Kalman filtering. Um, harvest panic during political explosion. So you can exploit this. This is what the firms will do based upon what this AI is saying. Then we also have dark pool cartography. Secret institutions trade around your orders like sharks scenting blood. So here's what they do. Uh, they look for map liquidity voids using NYSE floor print to see hidden order blocks in NASDAQ and SP 500. Strike when the abyss gave it back. When the buy sell ratio hits 10 to 1 at key levels, NASDAQ 100 at 18.5 algorithm, they push into the void. Then you ride the gamma serpent. Dealer must chase price if gamma exposure flips negative. This is why retail traders fail. They only see level 2 order book, a mirage. So you want to see this, the sacred spot gamma dealer gamma exposure, 5,000 a month. The trigger is peak dealer vulnerability. There's another one here on the tome. Secret silver hidden yield lies not in the spot price, but in the time itself. So this involves behind the futures curve. When silver December 24th trades at 30.50, but at December 25th at 32, which is a 5% contango. Short the present, long the future. Till this December 24th, buy the 25th, and delta hedge spot. Reap the temporal divide. Profit is as the contract rolls down the curve. Here's why the retail fails, because they're only holding silver ETF, leaking 0.5% monthly to rule the yield. Another sacred data point is COMEX warehouse stock flows, satellite imagery, and custom logs. I have no idea how they get that. I guess that's through the COMEX. So with the Astro trigger, Saturn and Pisces force industrial players to hoard physical metal. That's what's going on right now with the central banks. The next one, whale telepathy, on-chain secret Ethereum whales telegraph their moves in the blockchain bones with this UTXO age band. When 50% of Ethereum last moved below 3,200, those become the diamond hands. These are young coins, so when coins age less than a month, move distribution is imminent. Summon the leverage reaper, target liquidation clusters 3,400 and Ethereum 5, and that will trigger a $500 million liquidation. Here's why the retail fails. There's a Twitter gurus, and they're not using the Glassnode entity adjusted metrics. So that's at 2,000 a month plus liquidation heat map with Deribit. So the trigger here is the social contagion, or amplifies it. So it's crazy what we can find here. And again, if you want to know more, probably most people would be interested in NASDAQ. So we have the dark pool void ignition, 22%. And those are chasing the breakouts. There's also Ethereum in US dollar, whale cluster prophecy, 180, volatility adjusted following Bitcoin dominance. With silver, contango harvest and the gamma squeeze at 30%. So you hold silver and PSLV ETF. And we also have on the USD Turkish lira, volatility skew arbitrage 45%, buying cheap lotto puts. Now, let's saying this one's dangerous because it's very volatile. So for the mortals, you channel these powers. See me depth of book, 1,000 a month. Future liquidity voids, Glassnode academic at 200 a month. Decode the whale movements. You spot the gamma and track dealer gamma exposure. So here's a code logic, okay, in Python. Ritual timing right here. if you're into that. But here's some interesting things that this reveals. The greatest secret is no secret. Alpha Decay's infrastructure is the other big secret. So Citadel spends 1.5 billion per year on microwave towers, 0.003 second latency. Your edge is patience and discipline and exploiting the global panic cycle. Uh, and again, it makes reference to Renaissance technologies. Uh, uh, First 13.7-year path forward mortal, master one quant edge, silver contango, backtest with TradingView and Python free libraries, start small and risk at 0.5%. And most of all, respect the margin call Kraken. Okay, so there's that. The next one is interesting. Algo Edge, deconstructing high frequency trading secrets for the discerning retail trader. Financial markets battlefield, blah, 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 blah. Okay, on one side stand the institutional HFT shops armed with server collation, fiber optic, cable measured, blah, 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 and budgets for alternative data that dwarf the GDP of small nations. On the other stands the retail trader armed with a consumer grade internet connection, charting platform, and a dream. Uh, so the goal is not our HFT. The HFT, that's impossible. The goal is to understand their strategies, anticipate their flow, and harness their imminent market moving power for your own benefit. So we want to develop sophisticated multi-layered strategies for the instruments I've listed. Um, so we have institutional mindset. This is important to understand. It's not what you trade, it's how you think. And I've stressed it so many times that the most important thing when it comes to this overall success that brings out brilliance out of people, you could be the best programmer, you could be the best mathematician. When it comes to trading and trading experience, it's not what you trade, it's how you think. And that's specifically uh, for it's not just trading general, but algorithmic trading, quant trading for these type of shops. Um, so retail traders focus on price, institutions focus on liquidity. So here's the number one secret here: order book imbalance and micro price discovery. So for instance, if we have here the Brazil real and the USD, you see a candle. HFT algo sees a constant evolving mosaic of buy and sell orders at every price level. So there's market depth, and the primary goal is to predict the direction. It's to identify the temporary imbalance in the order book. So what they do is there's the BRL, USD, high yield volatile EM currency, large institutional flow are common. The algo will detect a large hidden sell order, Brazilian corporation hedging FX risk. The algo will then start pinging the market with small sell orders to probe for liquidity, essentially mapping out the other side's order. Once mapped, it will front run the large order by selling ahead of it and buying back at a lower price after the large order has pushed the price down. Interesting, eh? How can you use this? You cannot compete on speed, but you can use the effect of this activity. Retail traders should closely monitor the time and sales tape and level 2 data. Consistent series of sell orders hit in the bid, especially in large size, without the price moving down significantly, indicates absorption, a potential hidden buy order. Conversely, if the price is falling easily in small volume, it's just a lack of buyers and a potential liquidity gap down. This is a powerful signal for entry in this current market condition, British pound, New Zealand, or the euro dollar, which are often driven by large cross border M&A or hedging flow. So again, the hedging flow is the options and trading that a lot of the firms are doing, be it banks, trading firms, or whatnot. So the next secret, latency arbitrage and cross asset correlation. Let's see how many other. So there's three. Okay, so this could go on. Fasten your seatbelts, as they say. Latency arbitrage cross asset correlation. So they spend millions of dollars to shave the microseconds off their execution. They use latency arbitrage, exploiting tiny price disallocation between allocation of highly correlated assets based on different exchanges. So for the strategy, if an ETF like SPY, values derived from the S&P futures contract ES traded on the CME, due to the microsecond delays, the ETF price might lag and the future price by a fraction of a cent. HFT algos are built to buy the lagging asset and sell the leading one automatically, locking in a risk-free profit, uh, which is thousands of times per day. How can you do this as a retail? You can't arbitrage, but you can use the leading lag relationship. ES futures always lead the SPY ETF. For day trading, SPX or the Dow Jones Industrial Average, your primary chart should be the futures contract, ES or YM, not the ETF. A breakout in ES is that it isn't immediately confirmed by SPY. It's a strong, high probability signal that SPY will catch up. This is a foundational concept for trading indices that's in the futures market, not involving obviously options. So we have alternative data. Um, this is the grand differentiator. Retail traders look at GDP reports and earnings. Institutions are analyzing satellite images of oil tanker traffic, scraping social media sentiment, which can easily be done, analyzing credit card transaction, and monitoring corporate jet movements. Just some of the examples. Valuable data sets for your instruments. So, for instance, you can do Apple, SPX 500, or DGIA, order flow analysis. Okay, so there's these third-party services like Betterflow or Black Box Stocks. Retail facing, they provide a window. Unusual sweaty option activity, especially large out of money call or put purchases. Um, Often leading an indicator of major stock moves. $1 billion fund hedging a large position will leave a footprint in the options market long before the stock moves. So here for gold and silver, um, use the COT, Commitment Trader Report. Weekly report shows the position of commercial hedgers, which is the smart money, and this is how you want to do it. So large speculators like hedge funds and small speculators, which is the retail, commercials are extreme net long. It often signals a major bottom in gold. When there are extremes net short, it can signal a top. This is slow moving but powerful indicator. So I'll skip this one. We'll go back to the alternative indices, which a lot of people are saying you should trade as the US markets tank or not, or just go flat. So we have here Australia, Hong Kong 33, and the China H. So here you can have the China Economic Barometer for copper and gold ratio. Asian indices are heavily dependent on Chinese economic health. Institutions use proprietary indices that track real-time commodity imports, air pollution level proxy for industrial output. Interesting. Container ship traffic at ports like Shanghai. Copper gold ratio is a classic global growth risk appetite indicator. Rising ratios bullish for risk assets like AU 200, Australia. So here we're now looking at a strategy development for any of these. Uh, so the strongest buy conviction, that's as of today, a classic carry trade, candidate borrow in a low yield currency, invest in a high yield one. However, the simple carry trade is dangerous. Institutional approach is to enter only when volatility is compressed and the hedging costs are low. Okay. So again, that's why I need to take my futures and options course because this is critical if you want to really succeed at this. Uh, I don't know if I should do that, but let's just focus on this one. And let's see if we have gold. Yeah, so I'll focus on the ones I'm going to show demos on in C++, actually. So this one we'll do. So this is the British pound, New Zealand dollar divergence headline. This divergence trade within the G10 space. Institutions trade this pair analyzing relative monetary policy cycles of the Bank of England and the Reserve Bank of New Zealand. The advanced strategy is monitor the overnight index swaps market for both currencies. This shows where professional money expects future interest rates to be. If the market is pricing in more hikes from the BOE than the RBN and NZ, it creates a bullish divergence by uh, pound against the New Zealand dollar. This is incredible data to know. Okay, it's no, I mean, it can be considered secret sauce, but just knowing this, again, from this particular AI is very, very revealing, as I've said. And you can do this as a retail trader. So there's risk on, risk off filter. So it asks a risk off across when the global markets sell off, VIX spike, investors unwind carry trades, which often involve selling New Zealand dollar high yielder and buying pound. Your strongest buy signal can come during periods of moderate market stress. So the execution, fundamental divergence with a technical trigger. Wait for the price to be above a 200-day SMA for the RSI to cross above 50 from oversold territory at less than 30. This confluence provides a high probability entry. Amazing. So let's take a look at gold. So this is the institutional safe haven. So the thesis is gold is not just an inflation hedge, it's a fully diversified and play on real yield. So this is information you're not going to get anywhere else. The key driver, real yield, opportunity cost of holding gold, which pays no interest, is a real yield on government bonds. US 10-year tip yield. Gold has a strong negative correlation to real yield. When real yields fall, often when inflation expectations are rising faster than nominal yield, gold will rally. Future and option data, monitor COT, and that comes out once a week. Extremely net long positioning by managed money can be contrarian signal to everyone else, and everybody is already in. Watch the volatility skew in gold options. Again, you'll learn that from the course of futures and options. High demand for out of the money calls versus puts indicate institutional fear on the upside breakout. Execution. Build a long position when the 10-year tips yield shows signs of rolling over from the peak, especially if this coincides with the gold price holding a key support level, 200-day SMA. Use ETFs like gold or future GC for execution. Let's see here. So here we've got the and buy portfolio thematic and systematic approaches. So this is going to involve Australian, New Zealand, Australian, Canadian, Euro, SGD, and so on here. So this is Alpha Cross model, equity indices, which most people would be interested in. I'm not going to get that. And you can use it across Australia, Hong Kong, China, which are currently trading. We also hear a specific one for cryptos. I think we already gone on it. So here we're doing on-chain analysis, retail versus institutional. On-chain from platforms like Lastnode or CryptoQuant. So we're looking for a supply shock. When the number of coins moving from liquid wallets, frequent traders, to e-liquid wallets, long-term holders accelerate. It indicates smart money accumulation. Exchange net flow. Large net withdrawal from exchange suggests investors are moving to cold storage for long-term holding. Large net deposits to exchange indicate intent to sell. The execution used on-chain metrics as a background bullish bearish bias. Use technical analysis on lower time frames for precise entry. Bullish on-chain combined with a breakout above 200 EMA, high conviction, long signal. So here we got exotic and EM currencies, professor's toolkit, execution risk management, VWAP, advanced order types, stock market orders. These can fill out disastrous price slippage. Stop limit guarantees price but not execution. There's a correlation on the position sizing. Um, okay, I'll let you read. Well, if you get access to it, you can read it. Um, okay, so this is what we need to do, okay, as a market participant. The gap between institutional and retail trading is not defined by capital, is defined by informed. It is informed by its information process and discipline. You cannot rent a server next to the NYSE. You can shift your focus from price to liquidity and market microstructure. Incorporate alternative data like COT, option flow, and real yield calculations in your analysis. Again, option flow, which is the same way of saying option chain data, again, from my course. Think in themes and correlation, not just individual symbols. Execute with precision of a professional using advanced order types with VWAP. Okay. Um, so there's the robust GB, NZD, Ethereum USD are not just tickers. They're expressions of global macroeconomic forces. That's the classic fundamental analysis, and maybe once technical analysis has been mentioned so far. Applying layered, data-intensive framework outline here, you move from a passive observer of price action to an active interpreter of the market's deepest secret. Yeah, that's right. You begin not just to follow the trend, but to understand the immense algo engine that is creating it. So this is how you build your edge. Okay, let's look at the next article. I think that's it. Yay. Okay. So let's get into my code here. So what have we got here? There's two things I can show you. I'm going to show you that we have here two versions of a C++ system. Okay, again generated by AI with a more advanced AI LLM. Okay, so we have two different versions. The second version I'm going to run. Okay, this is why I've tested it against um, open source solutions. And from what I've been told by somebody else, thanks for their info, is that DeepSeek 3.1 will not run this because it's too big. Um, and that's a problem of trying to run on these home built solutions with these NVIDIA boards because you may be able to work it for 6 months. A month later, a new LM comes out and it blows out what you currently have spent a lot of money on, makes it right there obsolete. So my point there is you need to run cloud solutions using the direct um, coding interpreters or shells that these providers provide. The best one so far I've seen is probably right now DeepSeek, the new one, 3.1, and the latest from, believe it or not, ChatGPT 5. And out there, it's still there's some of the combination of the latest um, Quad 4, Sonnet, and or Opus. It's a combination. Okay, so let's take a look at this. So I'm going to focus on the second application because I think that is more important than, let's see here. It's not loading up my editor. Okay. Oh, there it is. Okay, so this is my README of this second version. Let me show you first the trading strategy. Now, part of experimenting with this to see how far I could get, that's so-called secretive modeling formulas that can be used by these quant trading firms like high frequency. I think you can do it. You can crack the nut on that. And let me show you how as an example. So you can do this all day, all night, as long as you're paying for LLMs and then a generator. As I said, I think the homegrown solutions are going to work. They're expensive. They're going to be outdated very quickly. And it takes a lot of processing time on your system. So here's a trading strategy. Okay. So again, educational purposes only. Um, so this is the asymmetric battlefield between the high frequency trading firms, the insiders, we call them the smart money, and then we, the retail trader, the dumb money. Okay. And so the retail trader will look at a price chart, two-dimensional plane of time and price. Institutional quant perceives a multi-dimensional data universe. So what they look at, there's a candlestick is merely the surface echo of a deep and churning ocean of order flow, liquidity, and information arbitrage. Okay, so the retail has a trading platform. The institution has collated server farm running C++ algos directly on the exchange matching engine, processing probably terabytes of proprietary data in microseconds. So this AI has generated a virtual article developing sophisticated trading strategies for two instruments, as I said before, um, British pound, New Zealand dollar, and the gold. So this is important to know. We will move far beyond technical analysis into the realm of what quant finance, market microstructure, and the secret playbook of market makers and HFT firms. But one thing I'll say about something like DeepSeek, and I'm now mentioning the names because we're half an hour in, that's getting there. What is being revealed to me, and you can, in one session, what I've shown earlier in those earlier articles and posts, what I'm finding is it will reveal the most darkest, deepest secrets. But then when you go back in asking for more, it waters down the results. It's that intelligent. As I said to somebody, imagine what we're seeing as a publicly released LLM from China that's used by the Chinese military, used by Huawei, and what they have access to, and what they're seeing, and what they could generate. I don't know what it is, but we're just seeing the public availability from China and the CCP, what they're putting out and making it publicly available to the rest of the world. I think that's just a public relations thing, a psyop basically, to say to the world, say, look how advanced this is. This is open source, but imagine what we've got behind the scenes that you don't have access to. So that's how advanced I think this is. Much more advanced than we have publicly access to. So, so let's go on. Institutional toolkit, data sets retail traders never see. Let's discuss the data. The edge doesn't come from a better indicator. It comes from better data sets. So there's the order book beyond level two. Retail traders might top 5 to 10 pricing levels, level two data. Institutions see the order book often for multiple venues at the same time. So it's a CME, Globex for gold futures, LMAX, EBS, and Reuters FX for pound against the New Zealand dollar. So here's our hidden secrets. Order book imbalance, OBI, and micro price. Institutions don't just trade the last price, they trade on micro price. Volume weighted average at the top few price levels. So here's the formulas that I asked for, and they gave it to me, which is kind of shocking. The formula is often an exponential moving average on the order book imbalance. So we have a micro price of the V bid, ask, and bid, and it's manipulated. I'm not an expert here. Where V bid and V ask are the volume at the best bid and ask, persistent positive imbalance of the two predict short-term upward price pressure before the move is visible on the chart. Number two, secret, order flow toxicity, lambda model. Market makers like Citadel or Jump Trading live in fear of toxic order flow trades from informed traders that lose them money, plus the brokers as well, let's face it. Especially in the retail market, especially in Forex, where there's a lot of manipulation, as we know. Uh, let's be honest there. Uh, they're not in your benefit to win in the Forex retail world. Talked about that many times. A model probability of informed trading thin, but in high frequency context, the key model is VP, volume synchronized probability of informed trading. Estimates toxicity by analyzing the volume and balance between the buyer initiated, seller initiated, and volume time buckets. So the VPIN is the V buy, V sell, total volume over N buckets. Okay, so here's what it says. Soaring VPIN indicates a rising ripe for volatility explosion, often preceding a large move. Now you might be asking, where do I get access to this? That's part of my Quant Elite programming membership. I'll be banging out stuff like this day in and day out. And you won't even know about it. Only my members will know. The other thing is, right now, my quant analytics is fairly affordable, and that will be merged into this quant lead, and the quant analytics will disappear. And the only way to get access to this is based upon very expensive pricing. Okay, so soaring VPIN indicates market ripe for volatility explosion. Oh, how do you get access to the quant lead membership? They email me. Just get in touch with me. I've got right here. Get in touch on my website. Right here. Anywhere on my website, quantlabsnet.com, and just get in touch. Simple as that. Okay, so a soaring VPIN indicates a market ripe for volatility explosion. So nobody's telling you this. Nobody's teaching you this. It's a secret. It's an industry secret. Often precedes a large move. Institutions will widen their spreads or cease providing liquidity when VPIN is high, causing a liquidity vacuum that retail traders experience before a crash or a spike. And I think we're kind of going through that right now on again, August 26th, when the markets, the US stock markets has been really flat. So they're possibly in a manipulated way, by the sounds of it, can be manipulated, where they can be manipulated a crash. Because it's been flat for the last week or so. Scary when they can do that, but they get away with it. So the options market data, the true sentiment gauge. Options markets where smart money hedges and expresses complex views. Retail looks at just put and call ratios. Institutions analyze the entire volatility surface. The valuable data set, volatility surface, is a 3D graph of applied volatility across different strikes and expiries. Now, you can generate probably that on your own. Then my course will kind of reveal it. That's a futures and options course. And then you can use like lightning charts to generate the chart. That's the volatility surface they're talking about here. The goal, the shape of this surface contains invaluable information. So you could trade like a pro and not just hang on to your bars. You can do some pretty fancy stuff in this space. Volatile skew smile, higher IV for out of the money puts versus OTM call indicates strong demand for downside protection. Bearish fear signal for gold. Conversely, a reverse skew can appear. So we have a term structure of the volatility. It's called a volatility cone. The curve is in tango, long dated IV, short dated IV, or backwardation. Short dated IV is greater than the long dated IV. Backwardation often precedes periods of stress and large move prices as near term uncertainty is priced higher than long term. So, are they saying I can predict that? Maybe. And if you can predict it, well, the world's your oyster. Valuable data set, risk reversal, butterfly strategy, 25 delta risk. Reversal involves buying an OTM call, selling an OTM put, or vice versa. Price of the structure coded as an IV difference. 25D RR is half volume points favoring calls. Is a pure, cost-effective measure of directional sentiment. A RR favoring calls in, as I said, PBNZD suggest institutional positioning for a rally. All I can say is wow. Hidden secret number three, volatility arbitrage with stochastic volatility models. Institutions don't seem volatility is constant, as with Black-Scholes. They use models like Heston or SABR that assume volatility is itself stochastic, randomly moving. And that comes back to the things called random walk. So right here, your AI from an institutional point of view, the advanced point of view, is showing that random walk theory that does actually exist. But you will always get why they call it the dumb money. They'll always argue it that there's a cycle, it can be predicted based upon the cycle, and they're just guessing. And basically, uh, well, relieving themselves in the wind is a safe way to put it for YouTube audiences. So here, the Vesta model is a partial differential equation, which you can see here, where these parameters include asset price, variance, volatility squared, the drift rate, long-term variance, rate of mean reversion of variance, volatility of volatility, correlation between price and volatility shocks. This is critical negative correlation. The leverage effect means down moves associated with higher vol. Volatilities deviate significantly from the model forecast they put on arbitrage trades, selling expensive options and buying cheap ones in a delta hedge combination. Sounds like what I said earlier. So here in the futures market, now again, that's in the options and the options flow, I guess the right way to call it, or the option chain data. Valuable data set, commitment of trader reports. Now, this is out once a week, so this is more passive. It's an advanced read. Retail looks at net positions. Institutions perform time series analysis on the data. And this is where the human-based traders think they're intelligent. And again, how it separates between professional algo trader using systematic processes, basically coding. Um, this is where you have the advantage over a human trader. And that's why a lot of human traders are pretty well moving into where we're going into irrelevant. The only way to trade now is with algos and coding, certainly in C++, along with the sophisticated and advanced AI-LLM models that are out there. I've looked at so many of these results I've not talked about publicly, but this is the first time I'm actually revealing what this is, and it's using again a Chinese AI, highly advanced now, new version 3.1. Calculate the volatility of positioning, the rate of change in net long short positions from managed money, hedge funds, and commercial hedgers. Rapid increase. And again, when you understand the hedge funds versus commercial hedgers, again, my futures and options course um, informs you on that. It's a very intensive course, but you can see we're already 48 minutes in this one video. This is how intense it is. But once you build out specific model source code, which I'll show you in a bit, you are patient enough, you will get reward there. So we're analyzing the smart money index by comparing positional commercials considered smart versus non-commercial speculator, often called dumb money. Again, my futures and option course stresses this so much, and this has been like this for decades. Divergence where commercials are heavily short while speculators are heavily long is a major red flag. Okay, so basis trading and exchange inventory. You will know and learn heavily what basis trading is in the course. But here, in a nutshell, the difference between the spot price of gold and the futures price. Winding basis can indicate physical tightness or financing cost changes. So when you talk to these doom and gloomers, or you watch these doom and gloomers or gold bugs on YouTube, they don't know what they're talking about. They're just guessing. But there's more techniques out there at the lower, beneath the hood concepts that are going on that the hedge funds and high frequency trading firms are taking advantage of. People complain they don't like it. Look, as far as I'm concerned, this is a capitalistic system. If you're in the smart money side and you know how to do this and you know how to code it, you're going to do quite well. And otherwise, you get put into the other bucket called speculators or dumb money. Which is how it is. Institutions also monitor gold inventory flows in and out of exchange approved vaults like FOMEX or LBMA. Steady drawdown inventory is a bullish physical signal, often at odds with paper market sentiment. Wow, this just goes on and on and on. So I'm not going to get into this, okay? There's another interesting one that you may know about as an HFT shop. This confirms what we know about. So then again, as an example, the pound against the New Zealand dollar, the volatility arbitrageurs cross, where the pound is a classic carry currency pair, reveals real edge for institutions comes from its high volatility and liquidity profile, perfect for statistical and volatility arbitrage. Sorry, that pair, pound against the New Zealand. So here we have multi-factor alpha generation. Institutional for pound against the New Zealand dollar will not rely on one signal. It's multi-factor modeling that weighs various alpha signals. And again, when you hear the word signal or alpha multiple times, that tells you that it's how you generate alpha, risk free as well, I might add. You can do it as a retail trader, but you got to be in the know. And the AI here is calling us here. So here we're able to predict returns using a momentum score, a value score, and a carry score. So a momentum factor, Z score of the price relative to its 3-month exponential moving average cross asset momentum signals from UK versus equity ETFs. Value factor, which is power parity, which I've talked about before in my course, deviation model, PPP deviation, current rate minus the PPP rate divided by the PPP rate. Large negative deviation suggests GPP is cheap. Carry factor. Outright interest rate differential. I'll talk about that in my course as well. So there's a difference between the two rates of the countries. It's classic carry. However, institution adjusts this for volatility adjusted carry or carry to risk. Interest rate differential, implied volatility. This identifies the most efficient carry trades. So we have a volatility factor, difference between short-term realized volatility and long-term implied volatility. So 20-day versus 3-month realized volume is significantly lower than implied vol, suggests the market is overpaying for options protection, creating an opportunity to be a volatility seller. So it's telling you exactly how it works. Of course, each firm will have their own uniqueness to it, but generally, this is how it works. So the high frequency market making strategy. This is the cool part. A lot of market makers are basically HFT is market making, and they make up. This is where they make up a load of profit when the right opportunity comes. In this case, right now, it's both British pound and New Zealand, and the gold market. So this is the hidden game. HFT firm acts as a market maker, providing liquidity on both sides of the order book. Now, it's legal or not, I don't know, but this is how it works. So at the core, we have this model, or it sounds Russian, Avalaneda Voikov model. This algo tells the market maker how to set bid and ask quotes dynamically to maximize the profit while controlling inventory risk. Its goal is to maximize the utility of wealth. So whereas XT is cash, QT is inventory, ST is asset price, and CT is a penalty for terminal inventory, resulting optimal bid and ask quotes are where we have current mid price, inventory aversion parameter, volatility, order arrival intensity from the firm's proprietary data. Wow. Time horizon. The secret. Okay, here we go. This is what I asked for. HFT firm is in estimating the flow of orders and the volatility more accurately. It's faster than anyone else. And remember, they have the trading data and the trading edge because they are operating at ultra low latency. So they use machine learning to predict a short-term order flow. That could be hard to generate for AI, but we know AI can make it happen. If their model predicts a flood of buyers, they will instantly widen their ask quote and roll the big quote to avoid getting kicked off, all before the retail traders stream even refreshes, pinging for stops. Now, this is a darker side for common practice. HFT algos will rapidly place and cancel small set of orders at technical support levels. This is what a lot of regulators are arguing on. They don't want this to be um, out there. It's not fair to retail traders, which is a good argument, actually. Previously, daily low. If the orders are quickly filled, it indicates the presence of a large stop loss cluster. The algorithm will then execute a large sell order, triggering the stop loss cascade and immediately back the asset at the now lower price for risk-free profit. This is why retail stop losses often seem to get hunted. And guess who does that as well? The retail forex brokers. Carrying on. So this is the pound and New Zealand dollar strategy, entry and exit triggers. I asked for this strategy, multi-term divergent trade with volatility overlay, primary and event trigger, low frequency minus daily, weekly. COT analysis, managed money net position must be rising from a historically oversold level where the Z score is less than 1.5, negative 1.5. Value 6. This is giving you the actual parameters. This is unheard of. PPP deviation must be below negative 10%, where GBP is the carry signal, positive and rising interest rate differential, which again I talk about in my course, the futures and options course. We have momentum signal, weekly MACD line crosses above zero. Oh, we forgot our first technical analysis indicator. Precision entry to high frequency minus 5 minute over 1 minute. Order book imbalance, sustained OBI, which we talked about before, is greater than 0.7. A strong buying pressure must occur. The PIN alert, which we talked about as well, must be elevated but beginning to decline from peak, greater than 0.5, indicating pocket selling flow is exhausted. Again, we're going to find out about what the option chain data can reveal. Again, in the futures and options course that I got, options flow. So a large buyer initiated risk reversals, trade favoring GBP calls and NZD puts. Is detected via option analytics platforms like for retailers, Squeeze Metric or Bloomberg Vol. Position sizing using Kelly criterion for dynamic sizing based on the strength of the signals. So there's a formula. We have a win probability of the strategy, back tested, and ours is the win-loss ratio. For more conservative fractional Kelly, half Kelly is used. Exit triggers. Wow, this is like written for you. So a profit take is when the target is on a 2-to-1 or 3-to-1 risk reversal ratio measured from the entry to the nearest significant resistance level. Alternatively, use a trailing stop based on the 20-day ATR at 2.5 times the ATR. Wow. Stop loss hard, break below a technical level, weekly low, confirmed by a reversal in the OBI to strongly negative and spike in the VPIN. Stop loss, which is quantitative, multi-factor model predicting return flips negative. Wow. That's all I could say there. I could go on with the gold as well. Macro exit volatility. Again, this is part of my quant elite membership. So execution, the final frontier of alpha. An amazing strategy with poor execution is a losing strategy. Institution execute is hidden secret number 4. Okay, so I didn't go into the details of this gold strategy. Okay, it's pretty involved. But you could probably generate code for it, as I'm about to show you. I'm not going to show you the code, but I'll show you the results. So the execution frontier. So this is the next secret. Implementation shortfall algorithms. Institutions never place a market order for a large position. They slice the order into tiny pieces and execute it over time using algos designed to minimize market impact. Of course, because just that, it'll have a market impact, which retail will see, probably along with it, regulators as well. So the VWAP, volume weighted average price, execute orders in proportion to the historical distribution throughout the day to match the average price. Time weighted average price slices the order into equal parts over a specific time interval. So the iceberg orders, small portion of the total order size to the position, 50 lots visible, 1,000 lots hidden. This is used to mask their true intention. I might thinking about it, I might show you the Python one as well. While we're going on about this long video, latency arbitrage. HFT firms with the fastest connections can see large order on one exchange, the CME. Race to buy the asset on a slower exchange before its price updates, instantly selling it to the large buyer for a tiny risk-free profit. This happens a million times a day. Oh. Synthesizing the institutional mindset. Okay, so this is where retail's got to get into this mindset. And for gold and pound against the New Zealand dollar, institutional perspective is not finding a magical indicator. It's about building a robust multi-layer system that incorporates proprietary data analyzing order flow, option volatility surfaces, and futures market microstructure. Quantitative modeling using stochastic calculus and multi-factor models to identify mispricing, calculate optimal trading sizes. Along with volatility arbitrage, understand that trading volatility is often more profitable than trading direction. Interesting. Trading volatility is often more profitable than trading direction. That's what the institutions do. Advanced execution use sophisticated algorithms to enter and exit positions without the market moving or without moving the market against you. That's the market impact. The strong buy signals for both pound against the New Zealand dollar are merely the spark. Institutional traders use tools and strategies outlined above to build a control, quantifiable fire around that spark. Managing risk at every single step in the way is completely invisible to the retail trader. Using a simple candlestick chart of money, right? This is the hidden world of modern finance where the battle is won on the chart, not on the charts, but in the relentless, silent, and hyper fast churn of data and profitability. Okay, let's take a look at the coding demo only after an hour long. Okay, so as I said, I've shown you the strategy. Let me go into the README to text just to show you what this code is doing, but I'm not going to share the code. This is again part of my quant elite. I could do this in and out every day, multiple times, and looking for the right indicators. Um, okay, so this is going to come back to what I've said before. Okay, so this is a fairly sophisticated set of code similar to what I just described. So we're simulating and using a low latency trading strategy in both the pound, New Zealand dollar, and the gold, using C++ for core logic and gnuplot for the charting. This is what it demonstrates: synthetic market data with microstructure, best bid and ask, order book imbalance, OBI, microprice, and trade print. So we have a low latency, friendly signal path, rolling stats with lock-free ring buffers, branch light logic, and pre-allocated memory. Low latency. And these are the features. Lock-free ring buffer. I've talked about that. It's a very popular topic on my website. Actually, I'd say one. It is the most popular. But now I've had this LLM generate the source code for that. Branch light logic and pre-allocated memory. Two strategy modes. So this is now the model that we're using, that Ladnita and Stoikov style market making with inventory control on the microstructure, short horizon alpha taker using OPI and VPIN, style toxicity, simulated order handling, TNL inventory and execution latency, generates a CSV uh, output for plotting with gnuplot, price signal order equity curves for pound against New Zealand dollar and gold, simulated order handling, P&L, inventory, and execution latency. So I think it's using version 20 of C++. So we have here the simulator, which generates the code. And then we have all these plots that are generated, again, using gnuplot. So this is important to know. This is just a toy, a dictatic toy. I've never heard that word before. HFT quant trading requires regulated venues, risk control, and substantial infrastructure. Do not use in production. So this is what it's doing. Looking for order book imbalance and micro price. We look at the OBI, okay, micro price, persistent positive OBI nudges prices up before the mid move. Our taker side tries to anticipate this. The VPN like toxicity, bucket cumulative, trader traded volume, and track average imbalance magnitude. Taker signals trigger only when the VPIN is elevated or rolling off. Potential liquidity vacuum ending. So this model, market quoting, it sets reserve price around micro price with inventory risk aversion. Skew quotes away from our inventory to mean revert to a target of zero inventory, where the execution is simulating microsecond delay and fills in simple top of book crossing logic. So it's equity plus cash plus inventory times the min. We log inventory, equity, and signals, turning ideas for experimentation. Increase mean in exec latency. So these are the functions. See degradation for slower reaction. Increase taker VPIN higher and taker thresh OBI to reduce false signals but fewer trades. Again, that's all in the source code. So here we tightening the spread ticks in synth params to market making margin thinner, stressing the AS model. It's using that that model, this one right here. Okay, so it's taking that model, and where did I go? This track here. Okay, so we're tightening spread ticks and synth params to make market making margins thinner, stressing the AS model. Raise vol and synth parameter to see convexity benefits for the taker logic. Extending toward the article macro layer. So again, we can build on this strategy if I wanted. So I'll show you the basics. We had a slow moving macro fair value for gold via a simple proxy of real yield and trigger directional overlay. Build a multi-factor alpha for the pound against the New Zealand with momentum value carry vol and let it modulate inventory cap and taker sizes. We have a Kelly style dynamic sizing on taker orders from rolling win estimates. And again, this is not financial advice. That is um, educational only. Okay, so um, I could just show you this code on the second. See here. Basically, it just generates the CSV of this and the CSVs. Let me show you the output of the first app, but that might reveal some more things here. HFT trading system. Okay, so this is the output of what it did. This is different using a different LLM. I believe this was, I can't remember which one this was. So here we have a starting capital of, I believe it's 10 million or whatever. Yeah, 10 million. So here we have the pound New Zealand cross strategy, micro price at 209, order book imbalance, VPIN toxicity, 0.64, alpha signal strength, confidence, market maker quotes. So these are the current. We also have the gold strategy, fair value at 1786, current price at 1950, deviation of 9.2, volatility signal. So arbitrage, no clear opportunity. So I've got coding samples in my file share for my quant league programming members. testing for that, see if there's a market trading opportunity. Nonetheless, we also have a Heston 3-month forecast range, okay, using Heston. So we have our risk analysis value at risk at 95%, 3.9% conditional variance at 95% percentile, 4.64 maximum drawdown. Ooh, that's pretty high. Sharp ratio 0.46. Hallmark. That's not really worthy. So here's the summary of what's we talked about: order book imbalance, or micro price calculation, VPIN for toxic flow detection using that AS model, market making algo, that's the stochastic model, volatility model, shadow rate modeling for negative rate environments, Kelly criterion, position sizing with fractional adjustment, VWAP, iceberg execution, volatility surface arbitrage detection, and the metrics we're using are all these: VAR, conditional VAR, sharp, and Kalmar. Again, here's our triggers. Entry, OBIs greater than 0.3, VPIN less than VPIN. Multi-factor alpha more than half percent. Exit, dynamic volatility adjusted stops, mean reversion to fair value. So it's a pretty powerful set of things here. So let me show you the charts that get generated with this piece of code here. Um, uh, so I have to know how to run the gnuplot. So we have these two plot with the instructions. Um, let's see here. Okay. I think I have to read this one. So what I could do, oh, right here. This is what I want. Okay, so we have new plot here. I'm gonna run the first one. It should work. Um, let's copy that. Again, you could tell I'm running this in a Windows subsystem of Linux for Ubuntu 22. So here's the chart, the first one. Hope it works. Yeah, here we go. So this one's the uh, price of the, the of the British pound against the New Zealand dollar. Okay, so here, um, if we set our delay in seconds with price, you can see what's happening here. We have a uh, mid, micro. Um, I believe this has just been generated. So here you can see here our market structure signal and equity. We don't have our OBI and sell signal in here for whatever reason. Signal and equity, equity market, mark to market inventory. So again, I'd have to kind of iterate to showcase this better, which I can't be done. But I just want to show you just the first touch of this. So the next one we're going to show you is, yeah, it's gone. Okay, so let's go and visit the next one, which is this one right here. Okay, so that's the believe gold. Let's see here. There we go. You can see the price is going down based upon time. Again, this is all simulated data. It's not real world market data, just so you know. I guess we got to wait it out for the other to get generated. I don't know how big the uh, charts are. Let me just see if I can. The data is pretty big, I think, generated from that C++ program. Around, but I'll leave it at that. But if you look at the size of the data that's generated, and again, this is micro, and it's all simulated. If you pay on something like um, interactive brokers, you can do this, but the frequency and the frequency of the trading, the commission fees, I think, alone will kill you. As it's suggested in the document, read me, it said that you should be on a CME direct access to really benefit from this rather than having a big trading account. The point here is that we're able to generate the source code, reveal the secrets behind it all, specific for these two assets that look to be profitable in the next little bit, with very precise triggers on the entry and exit and the whole logic that goes with it to reveal quote unquote the secrets, which I think it does. Um, yeah, so it's pretty powerful. So as I said, if you want to know more, you got to join my quant labs that um, e-newsletter. At the same time, get the ebook, the C++ HFT ebook. Uh, there, you'll get on my newsletter, and I'll may put out some more samples of this. But the quant lead to get into it, you just gotta reach me here at quantlabsnet.com and get in touch, and I'll be able to start the conversation via email with you. That's pretty well it. But I just, as I said, I want to show that this can't be now revealed because of this particular model that's out there that just got updated about a week ago. Other than that, thanks for watching. Have a good day.